Hey, welcome. So today, we are diving into a financial strategy from our source material that is, well, it's pretty radical. It asks a really simple question. What if you could fire your banker and just take over the job yourself? Let's break down how you might be able to reclaim one of the most powerful financial functions in your own life. So let's just start with a question that really gets to the heart of the problem. For most of us, our money only seems to flow in one direction, right? Out. And according to our source material, this constant outward flow means we could be losing thousands of dollars every single month, mostly to just one thing: interest.
I mean, this visual pretty much captures a process we all know way too well. We work hard, we earn our money, and then boom, we immediately pump it right back out. Your mortgage, your car loans, credit card debt. It's just this constant river of capital flowing away from our households and straight into the vaults of financial institutions.
You know, our source material uses a really powerful analogy to describe this. It's like you're in a boat, but the boat has holes in it. You can bail water as fast as you can, but as long as those holes are there, you're gonna sink eventually. And those holes? Yeah, that's the interest and the principal payments you are constantly making to somebody else's bank.
So, this brings us to our first section. We're going to frame this problem of constant interest payments as a kind of invisible leak in our personal finances. A leak that the whole concept we're talking about today is designed to plug. So, what exactly is this concept? Well, according to the source, this is not about buying some kind of magic product. It's about adopting a whole new process. It's the process of systematically taking back the two core functions of a bank, saving and lending, that most of us have just outsourced for our entire lives.
And that leads us right into our second section, which is all about what it truly means to become your own banker. This is a fundamental paradigm shift. It's about changing how you see and control your money, root and branch. So, here's the crucial point. The entire system, the whole thing, it hinges on changing just one habit. Instead of parking your savings in a traditional bank account first, you redirect that money into a totally different kind of financial vehicle. And that single change, well, that's the engine for this entire process. Now, the specific tool for this process is a specially designed whole life insurance policy. And I mean, it can't just be any policy off the shelf. It has to be from a mutually owned company, which is important because that means you, the policyholder, get to share in the profits through dividends. It means a guaranteed interest rate, and this is key, it has to be structured for high early cash value. That design is so important because it lets you access and use a big chunk of your money almost right away. Okay, now that we've got the what and the why, let's get into the how. In this section, we're going to look at the actual mechanics of putting this system into practice. The source material breaks this down into a really simple, repeatable four-step loop. First, you save by systematically putting money into your policy. As you do that, you build your cash value. Then, when you need to make a big purchase or pay off a debt, you borrow against your policy. And finally, this is the most important part, you repay that loan with the same money you used to send to a bank, recapturing those payments for yourself.
Okay, this right here, this highlights the single most important difference in this entire process. Think about it. When you take money out of a bank, your money is gone. Its ability to earn anything for you stops, dead. But with a policy loan, your entire cash value stays right there in the policy, continuing to earn guaranteed interest and potential dividends. How? Because you're not actually touching your money. You're borrowing the insurance company's money and just using your cash value as collateral. This is the secret sauce to uninterrupted compounding growth.
Now for the really fun part. Let's see how this process actually lets you recapture money that you were previously just giving away forever. Let's use a super clear example from the source. So imagine you have a credit card and it's charging you a nasty 20% interest. Before the system, that 20% is just gone. But now you take a policy loan, let's say it costs you 5% interest, to wipe out that credit card debt. Then you take the exact same monthly payment you were sending to the credit card company and you pay it back to your own policy instead. You've just plugged that leak. And this is where the power really multiplies. You are now making money in two ways on the very same dollar. First, your policy's cash value is still growing, even with a loan out against it. And second, by getting rid of that 20% high-interest debt, you've recaptured that massive difference between what you were paying and the low interest you're now paying yourself back. You've literally turned a huge expense into an opportunity to build wealth. But this strategy isn't just about paying off debt. It's about building long-term, generational wealth.
And our source illustrates this with a really powerful case study that spans decades.
So check this out. It's a case study from the source about a policy that was started for a daughter, Vivi, when she was just 6 months old. It is the perfect example of how this system is designed to work across an entire lifetime and then some. This one policy, just funded systematically over time, is projected to finance all of her major life events. We're talking her college education, a wedding, the down payment on a house, even her own child's college education. And then, on top of all that, a substantial tax-free retirement income. And it's all done through a series of policy loans. So you have to be wondering, what did it cost to build this financial engine? Well, according to the projection, over the course of her entire life, the total amount of money paid into the policy is just under $400,000, okay? Remember that number, $398,000. Now, from that contribution of less than $400K, how much money was actually accessed and used for all those life events? Over $2.7 million. All of it taken out as tax-free policy loans. That is nearly 7 times the amount of money that was ever paid in. It's incredible.
And here it is, the final, most astounding point from this entire projection. Even after financing an entire lifetime by taking out $2.7 million in loans, there is still a projected $2.9 million of cash value left in the policy. Still growing, still compounding, ready for the next generation.
So we'll just end with this question. Based on the process that's outlined in our source material, could changing that one single habit, where your money goes first, truly transform how a family views, controls, and uses its money, not just for a lifetime, but for generations to come? It is a very powerful idea to think about.